What's up guys? So today I wanted to do a Q&A for all of you millennial investors out there. These are questions I've received from my Insta page. Guys, if you're not following me, I'm at Warren Gosling, so follow me, soak up my content and DM me with any of your questions and I'll put them in an episode. If you like the format of this today, I'll do more. Who knows, I might even give you a shout out too. So yeah, these are questions that I've received from my Instagram page, from DMs, by email, by text, discussions in the pub, all of which I think a lot of people are wanting to know when it comes to becoming financially literate and educated. And you may even be thinking of yourselves at home. So I thought I'd share them with everybody and we can all learn together and benefit the community through doing this. So quick disclaimer before I begin guys, I am not a professional financial advisor. This is information based on my 10 years experience working in the banking industry and my personal investing journey in stocks and shares and property. Everyone's financial goals and circumstances are different. So please do your own research in addition to this and validate what I'm saying and seek professional financial advice if you have to. So I love answering all of your money questions and financial questions on this channel, but the goal of this education is really for you to get all of the tools and foundational info that you need to think for yourselves, to research for yourselves, and go on to make profitable and informed money moves. So here goes. So these questions are about investing. First one is, hi Warren, just got another question. He'd asked me a couple already. What is the difference between income units and accumulation units? So this question refers to investing. It relates to investing in the stock market. Usually when you invest in funds, you have the choice between what's called income units and accumulation units. I actually covered this a week or so ago in an Instagram post on my page. So you can head over and actually see the information that I put up about income and accumulation units. So the difference is that with income units, if you're paid dividends, this money is paid to you as cash money, right? Into your hand or your account, happy days. But with accumulation units, if you're paid dividends, this money is reinvested to buy more shares rather than being paid to you as cash money. So that's the difference between the two, but which one do you choose? So I'm not a financial advisor, so I'm not going to tell you which one you should do or which one you should choose. But what I am going to tell you is the benefits with each and how you can make your own decision. So with income units, where you get the cash, the benefit is that you get your cash when dividends are paid, and now your profits are there in your account and you can spend them as you wish because it's cash. So if you're a millennial investor and you're looking for income and you have purchases that you want to make in the short term, so maybe a holiday, a car, home improvements, etc., then that's you covered with the income units. With accumulation units, the benefit is that the cash is reinvested to buy more units of shares, and this compounds over time. So here's an example on the screen. So if you're not desperate for cash right now, this is a great option that you can use to build wealth in the long term. So it really all depends on what your objectives are for the long and short term are, guys. So next up is a question about when the right time is to take your money out. So I was asked, would you put in, say, £100 and only take it out, that's into the stock market by the way, and only take it out when it was thousands, or do you keep it dripping in over time? So this really comes down to what your goals are, as I alluded to in my other question, guys. If your goal is fast money, well, it's pretty much cut and dry for those people. So if you receive dividends and or the price of the shares that you own goes up, you're going to be more inclined to sell up and take the money out and go buy a car, a watch, a holiday, clothes, if you're into the fast money option, if that's your goal. If your goal is to build more significant levels of wealth over the long term, you're going to leave it in and give it time to grow. So here's that image again. I love it because it really drives this point home. What is this image showing us? So it's showing us how the UK stock market has grown over time since 1986. When you scan from left to right, you can see that when you buy shares and reinvest your dividends, i.e. the accumulation units option that we just talked about in the previous question, your growth is compounded over time. And you can see this in a lighter shaded area on this graph. So If you'd have invested £10,000 in 1986 into the FTSE 100, that's when I was born by the way, and just did nothing with it and let it grow over time, you'd have £196,000 today just by being long-term minded. So I know which option I prefer, but everyone is different, so make your own decisions, guys. So follow on question. What kind of sums do people put into these stocks and what happens when you make profit? Okay, so first question on what kind of sums people put in. So there's this false assumption that you need to have thousands of pounds to be able to participate in the stock market, and that's really not true, guys. When I started out, I was putting in 50 quid a month. Because I didn't know what I was doing really, if I'm honest. I was learning as I went along and I didn't want to risk too much, and that's a really great strategy to start off with, by the way. And B, that's all I could literally afford to do at that time. So I invest a lot more money per month nowadays, but just start with whatever you can afford, guys. The key is to just get started. It's not about the amounts, guys, trust me. Okay, next question. How did you learn to read the stock market and funds? How do you generally tell when the stock or fund is doing well apart from trend graphs? Okay, so I really learned about how to read the stock market through listening to podcasts. This is really my preferred way of learning. Everybody's different. Some people prefer to read books. Some people like reading resources, other types of reading resources. Some people prefer teaching, but I'm all about podcasts and YouTube, by the way. And there's so many out there, guys. Money Saving Expert is also a really good source of free info, guys. I really recommend them. They're literally a fountain of knowledge and really useful, so check them out. In terms of how I generally tell if a stock or a fund is doing well, again, I'm not a financial advisor, but I tend to look at the annual return for my investments, guys. So this is a figure which is a percentage, and it represents all of the dividends, interest, and the change in the value of the shares over time, or over the last 12 months, basically. It's a collective aggregate figure for that, guys, and that's very useful. So next up, do you really trust the investing platforms and apps with all your money that much? I would be scared to have too much in there and not take it out. So this is absolutely a question you should be asking, guys, when it comes to your money. Whenever you put your money somewhere, it has to be safe, right? So I would highly recommend that you either go onto your potential provider or platform's about or FAQs section, frequently asked questions. This is usually on their site, and look at what they themselves say about how clients' money is protected in the event of insolvency, i.e. that the platform can no longer pay its debts, and fraud, which is where employees or outside hackers, say third parties, engage in deceitful practices to steal your money. So in the event of insolvency, what you really want to see is a statement to the effect that the client's cash is ring-fenced, guys, or kept separate from the platform's own cash. That's what a ring-fenced amount means. So what this means in practice is that the platform is not able to use yours or other clients' money to, say, open a new office in the Seychelles, or to pay the platform CEO a chunky bonus. Your money cannot be touched by the platform because it's for investment purposes only, okay? You also want to see that the platform is regulated by the FCA, that's the Financial Conduct Authority. They're a branch of the Bank of England, and they ensure that all of the financial institutions in the UK behave themselves. And they act with integrity so that customers can't be ripped off and the economy essentially remains stable and secure. So the provider will have to operate under certain rules under this, which the regulator sets, and that are designed to achieve this. Lastly, you want to see that the platform is part of the Financial Services Compensation Scheme, and this is a scheme that's set up by the UK government that basically pays clients like you and me if the platform has, say, committed fraud and stolen your money, or they've not made the investments that you've instructed them to do. So this is basically the government acting as a guarantor for your money. And then lastly, a pro tip, you might want to choose a platform that's been in operation for a good amount of time, 5-10 years, and not one that was just set up yesterday in the last 3 weeks, because one that's been in operation over time tends to be a bit more credible and trustworthy. So that's it for today's money questions, guys. I hope you found it informative and helpful. As I said, if you have any questions that you want to know more about or dig deeper into, feel free to head over to my Instagram, get in contact, send me a DM, and I'll be happy to answer your questions, or comment down below and I'll answer your questions, guys. Cheers. Bye-bye.